Maya was standing in her kitchen at 9:15 on a Tuesday, staring at a stack of mail she'd been avoiding for 4 days. She already knew what was inside. Opening it would just make the number real. 14 months earlier, she'd signed for the house she'd been picturing since she was 26. Her loan officer called her a model buyer. Nobody mentioned the bill that never shows up on a mortgage statement. Maya, 36, runs a physical therapy practice in Denver. Household income with her husband Daniel, $164,000. 5 years of saving built a $138,000 down payment. Credit score, 774. Careful people. Purchase price on the house, $685,000. Monthly mortgage, $3,420. The bank approved them in 9 days. Every online calculator said the same thing: affordable. Maya believed, like most buyers do, that if the mortgage fit, the house fit. That assumption is wrong because the mortgage isn't the cost of the house, it's the entry fee. The real cost arrives in 7 waves. Wave 1, utilities. Their old townhouse ran $180 a month combined. The new house, more than double the size, doesn't cost double to heat and cool. It costs far more because bigger homes lose more heat through more walls, more windows, more roofline. Combined utilities landed at $5,700 a year, $3,540 more than before. Insurance came next, $3,600 a year on the new place versus $840 on the old one, nearly triple, driven by rebuild cost and wildfire risk classification. None of that appeared on the pre-approval letter. Wave 2, the 1% rule. Budget roughly 1% of home value annually just to maintain it. On this house, about $6,850. Maya's first year arrived as a string of small disasters: a failed water heater, $2,800, a roof leak, $1,900, a dead sump pump, $1,050. Total, $6,950. Budgeted, 0. Wave 3, furniture. An empty dining room, an unfurnished guest suite, a living room that swallowed their old sectional. 18 months, $18,600 spent. Over $9,000 of it financed at 24% interest. The dining room has been used 9 times since. Wave 4, property tax reassessment. Colorado reassesses every 2 years, and this cycle caught 2 years of steep appreciation. Maya's tax bill jumped from $6,200 to $8,900, $2,700 more, permanently until the next cycle raises it again. Wave 5, the neighborhood tax nobody names. Landscapers on every block, string lights before Memorial Day, and HOA notice about her lawn during a dry August. She hired a landscaper, sealed the driveway, bought patio furniture. None of it planned, all of it roughly $6,400 a year, driven by nothing more than visible comparison to the house next door. Here's why this happens to careful people, not reckless ones. Maya wasn't just buying square footage. She was buying proof that 11 years of building a practice from nothing had actually amounted to something. That's what Dream Home is designed to do: fuse a financial decision to an identity so completely that the buyer stops running numbers and starts defending a picture of her own life. The staging, the lighting, the listing photos, all engineered to move a buyer from the analytical brain to the emotional one before she signs anything. Here's Wave 6. Getting out isn't free either. Real estate isn't liquid. Selling costs 7 to 8% between commission and closing costs. At a healthy 4.5% annual appreciation, Maya's house would be worth about $782,000 after 3 years, a $97,000 gain on paper. Exit costs eat roughly $58,650 of that. Net realized gain about $38,000 before subtracting a single utility bill, repair, or piece of furniture along the way. Wave 7 is the one that never shows up in her checking account. The $138,000 down payment stopped being liquid the moment it hit escrow. Left in a broad index fund compounding around 10% annually, that same money would be worth roughly $222,000 in 5 years, $358,000 in 10, over $900,000 in 20. That's the real cost of the down payment, not what she spent, but what she'll never earn. Total it up: mortgage, tax, insurance, utilities, maintenance, HOA, lifestyle spending, furniture debt, roughly $81,000 a year against $122,000 in after-tax household income. The house is consuming 2/3 of what they bring home. Retirement contributions dropped from 15% of income to 5%, not by decision, just because nothing was left. None of this means don't buy a house. It means one number, the mortgage payment, was never the whole picture. Total housing costs shouldn't exceed 28% of gross income. A down payment shouldn't eat more than 30% of liquid savings. And before signing anything, run the 5, 10, and 20-year model: the opportunity cost of the down payment, the friction of eventually selling, the real lifestyle cost of the neighborhood. A house that clears all 3 tests isn't a compromise, it's an asset, and it's allowed to be beautiful too. Maya still lives in that house. The dining room table is still waiting for the next holiday. The most expensive number in any home purchase was never on the listing. It's the cost of the story you tell yourself about what the house was supposed to mean.